Hi everyone, I'm Andrew Murphy from Winthrop Wealth. In today's video, I'll be talking to you about the coronavirus and the effect it's had so far on the US stock market. I'll also be detailing some strategies on how to navigate through the current period and through any challenging market environment. In the past week, we've put out several written pieces, including one on the recent market volatility, our February recap, and our client question of the month piece, which details the coronavirus, its expected impact on the US economy, and how the US stock market has performed during other previous health emergencies. As always, if you have any questions, please feel free to reach out to me directly or to anyone at Winthrop Wealth. Let's see how the coronavirus has impacted the US equity markets. This is a chart of the S&P 500, and as you can see, the market was off to a great start this year and actually hit a new all-time high as recently as February 19th at 3386. And then really fears over the coronavirus took over and the market dropped by 12.7% in just the last 7 trading days of the month. But let's step back for a second and put the recent decline into context. This is a chart of the S&P starting in 2019. As a reminder, the market increased by 31.5% last year. So even with the most recent decline, the market is still up 20.6% over the last 14 months. Overall, US equity market has still produced strong returns despite the latest sell-off. Now, where do we go from here? As of now, it's our view that it's still too early to assess the impact of the coronavirus on global markets and economies. But of course, we're monitoring the situation closely. Our advice in the current period and whenever markets decline and there's volatility remains the same, and it's to do 3 things. Put the environment into perspective, avoid making emotional decisions, and rely on the combination of comprehensive financial planning and investment management to help you reach your long-term goals. First, put the current environment in perspective. Remember that the equity market has generally produced positive results over long time periods. This is a chart of the S&P going back to 1928, and you can see the market goes up over time. The total annualized return over this period is about 9.5% per year. However, the results were not linear. The market didn't just return 9.5% every year, as there were plenty of declines, corrections, and bear markets along the way. We know that equity markets can be extremely volatile over short time periods, and the last week is just the latest example of that. Now, this is one of our favorite charts. These are the calendar year returns of the S&P going back to 1980. Those are the bars. And the red dots represent the largest intra-year price decline. So since 1980, while the market has returned about 12% per year, it has averaged a decline of almost 14% every year. Really, the latest drop is about in line with what has happened in the market every year over the last 40 years. And this is why we remind our clients to maintain a long-term viewpoint and avoid getting caught up in the short-term noise. Because while the market goes up over time, volatility and declines are very common. Next, avoid making emotional decisions. We understand that market declines are stressful and that no one likes to see losses in their accounts. However, keep in mind that the loss is only on paper unless you sell and lock it in. We also know that the news will sensationalize the coronavirus or really any market decline, but keep in mind they care about ratings, not providing sound investment advice. So in these periods, we stress the importance of controlling your emotions and avoiding the impulse to try and time the market. We put out a lot of pieces on market timing and exactly why it doesn't work. But to market time, you must get 2 decisions exactly correct: when to sell out and when to buy back in. And we know that no one is able to do this consistently. Most investors fail at the second part, buying back in, and they often do so at prices higher than when they originally sold. Market timing decisions are often emotional rather than rational and data-based, and these decisions are a major reason for poor investor performance. Last, rely on the combination of comprehensive financial planning and investment management. At Winthrop Wealth, the financial plan defines cash flow needs, optimizes account structures, considers tax minimization strategies, and determines the appropriate asset allocation based on the client's willingness and ability to take risk. The plan really provides a roadmap to the client's future goals and objectives, and it's stress tested for many different environments, including extreme volatility and market declines. So the right financial plan provides transparency and it can assess the impact of market events. And this offers peace of mind and can help mitigate the emotional reaction to market volatility. Our investment management process is designed to provide well-diversified portfolios constructed with a methodology based on prudent risk management, asset allocation, and security selection. We help our clients navigate these challenging markets by ensuring their cash flow needs are met while managing the rest of their investments in globally diversified portfolios. Recently, we put out a whole series on portfolio diversification, and we know that diversified portfolios can lower volatility and increase consistency. Since we actively manage our clients' portfolios, I'll also point out that we can use these volatile periods to our advantage by tax loss harvesting or reallocating to more attractive securities. We understand that market drawdowns are stressful. However, especially during these periods, the right mindset, paired with a comprehensive financial plan and a thorough investment process, can provide a sense of comfort and confidence in meeting your long-term financial goals. We hope you enjoyed the video. Please feel free to reach out to me or to anyone at Winthrop Wealth if you have any questions.